Okay, we're going to get started today by looking at the calendar. All right, so we are right here in the calendar. We have we just got through another week of earnings season, and that's just about wraps up the important stocks that are reporting in this earnings season. We have the Fed that is meeting next week, Wednesday and Thursday, and it's widely expected that the Federal Reserve is going to reduce the interest rates. We don't know how much, but that will definitely affect a lot of the stocks we're watching. Um, we also have triple witching. This is the day where options expire. A lot of options expire at the same time. And because of that, there's volatility. So expect an extreme amount of volatility, plus or minus, on next Friday. So we're going to have volatility one way or another with the um, decision the Federal Reserve makes for interest rates. Then we don't have a whole lot of news. We don't have a lot of earnings reports next week or the week after. Um, we do have end of quarter window dressing where um, money managers they buy some of the stocks that perform the best in the quarter, and makes a little bit of that adds to the stock market going up. And then we have October. It's traditionally a good month. So if we look at our seasonality calendar, we can see that we're coming out of one of the worst months of the year. And then we have 3 months that are some of the best months of the year. So um, if we do have some volatility sometime this month, it usually is a good time, a good entry point for stocks because we have the end of the year to look forward to. And we expect a lot of volatility also during this month. All right, so what else? What else is going on? That's it. So let's look at the earnings reports that came out this week. We didn't have a whole lot of activity. We had Oracle was one we were following as a very important stock. They actually um, they didn't meet their earnings estimates, and but they guided very highly. So they guided um, better than expected. We'll go over that later on. And Oracle is kind of an overpriced stock right now, it seems. But it seems like they are becoming an AI stock. A lot of times AI stocks have an aura around them and they trade for a higher multiple. So we'll see we'll look into that stock later. And Adobe reported it didn't go up or down a whole lot. Adobe is trading right now right around, I think it's fair value. It is totally out of favor, and it is a blue chip stock. Um, we're going to go over this one too, because it is one of the most out of favor, worst charts in the stock market right now. And sometimes whenever stocks are down a lot, that's whenever you might find um, a diamond in the rough. Okay, so we didn't have any other big stocks report. Next week, there isn't a whole lot of reports remaining. We do have, let's look at our calendar. We do have NVIDIA. No, we don't know. We have, no, we don't have any more earnings reports this quarter. So we have FedEx and Lennar, maybe a home building stock. And of course, everyone knows FedEx. But relatively speaking, none of these are really that market moving important. So okay, so look at what happened in the last week. The S&P went up 1.5% from the last week. Um, we still have a neutral kind of momentum, 50%, around 50 or 60% above their 50-day moving average and 200-day moving average. So we also have kind of an unchanged 10-year, and we have a 2-year that's down 4%. So if we look at our Let's look what I'm. Okay, we look at the U.S. Treasury. We actually went up 0.05% on Friday. So we went up just a little bit. And earlier this week, it's been going down for at least a couple weeks now. And recently, in the past day or so, it started going back up. So usually our formula is as the U.S. Treasury yield goes up, the stock market goes down. That's kind of the inverse correlation that we've had for a while. It doesn't always work out perfectly, but it makes sense. If you have a U.S. Treasury yielding 10% and stocks have a average return of 9%, then who's going to want to put their money in stocks when you can have a guaranteed return? So that's kind of the theory around this. So we're going to research, the stocks, keeping in mind this week that the Treasury has been going up in the past couple of days. All right. So let's look at, we have oil down maybe 3%. We had talk about production increasing in OPEC, so that could be the reason why. Um, inflation it went up just a little bit with the earnings report, with the reports from the government this week. It went up just a little bit, and it was 2.7, now it's 2.9. It seems like tariffs are kind of adding to inflation a little bit. And the US dollar hasn't moved since last week. It's unchanged. Gold is up 5% from last week. That is a lot. And let's look at the chart for the US dollar. You can see it continues its downtrend. And I'm not a dollar expert, but let's look at our formula here. Every move up and down 10% in the US dollar equals 3% bonus or hit to S&P earnings. So the stocks are, I mean, the dollar has been going down. That's going to help the earnings of the S&P and particularly multinational companies. Okay, so let's look at other fear and greed index. We can see that we're neutral this week. So we don't really have any action to take in general. Whenever we have extreme fear, we start looking for things to buy. Hold your nose or don't sell. When you have extreme greed, we have caution. Take some profits off the table and don't buy. But right now we're in the middle, neutral. We're kind of in seasonality wise, the worst month of the year. People are kind of not making many commitments to their investments. So let's look at the AAII sentiment survey. We have most are bearish. That's fourth week in a row. So whenever the amateur investors are bearish, that's like a sign to buy or don't sell. Okay, so let's look at the VIX. It is a multi-year low right now. It's at 14 and change. So there's no fear in the market right now. Um, yes, we've had good earnings reports. We don't have a whole lot of reason to fear. The stock market kind of discounts tariffs as a paper tiger. Paper tigers are um, things that seem bad, but it ends up being just talk and nothing behind it. So I guess tariffs are the only unknown right now, but the stock market is kind of ignoring anything tariff right now. All right, so right now we have in our emotional graph, I'd say we're coming down from, extreme greed, where we're kind of neutral, kind of denying that there's any problems. We are approaching a week where we're going to have a lot of volatility, so we're going to have a little bit of fear coming in the next week with the triple witching day. And we have the Fed talking. So if the Fed doesn't reduce the rates as expected, or even if the Fed reduces rates more than expected, good news is bad news, and bad news could be bad news. We don't know how the market's going to interpret what the Fed does. So we do have an overvalued market that could cause a correction. We have we do have an economy that's slowing down. We have job reports that are worse than expected, meaning we have a slower economy. So these are all things that could cause problems in the stock market. And of course, something happens with tariffs. Um, we wake up tomorrow and we might have a news story about tariffs that could make the stock market go up or down. All right. And let's look at, okay, so the PE ratio right now is around 25 according to Yahoo, no, according to Wall Street Journal. And that's traditionally very high. Matches up to some of the peaks in the stock market. If we go back to the .com crash, we have the um, other times we have a financial crisis. All right, so we have that same premium in the stock market right now. So that means we could go down 20% and be fairly valued. All right, so let's look at our worst to first from the beginning of the year. The best from last year, IT, communication services, consumer discretionary. Um, this year, we have communication services such as Facebook, Google, um, related kind of stocks. Those are up 24%. That is the best sector. Next is IT sector, and we have industrials after that, and then materials. And the worst sector are healthcare, energy, and consumer discretionary. So healthcare and energy were some of the worst of last year also. I think healthcare is down this year because Trump has been threatening to charge this, ask drug companies to provide the same rate that they're charging other countries. Other countries have gotten a cheaper price for drugs, and there's threat that Trump might force drug companies to give us that same rate. And so that threat is one of the reasons why drug companies are down. Um, energy stocks are down basically because of the price of oil is down. And even if you have the best run oil company or energy company, if the price of energy or oil goes down, then your stock is going to go down with it. So that's the tricky part about investing in energy companies. And okay, that was great. Now let's look at the updated version of this PE valuations relative to history. We have energy, healthcare being the least expensive compared to history. They're at a 50 percentile, and 30-year at 44 percentile. So these are really cheap compared to history. Um, the ones that are the most expensive compared to 10-year and 30-year is consumer discretionary, IT, and industrials. And you can see even the S&P is at near the 90 percentile valuation wise from 10-year and 30-year. So we are very, very, we're at a very pricey stock market right now. All right, so let's look at some of the stocks going up and down the most today. Okay, hold on. Okay, so we're going to look at the 10-year. No, the 10-year is going up. Okay, so our translation is yields of the 10-year going up. Positive for large cap, financials, brokerage firms, insurers. Negative for high yielding stocks. Let's see if that's what happened today. Okay, we have home builders. So as interest rates go up, the cost of mortgages and buying a house goes up. So there's less of a demand for housing. So that makes sense. So this the stocks going up and down the most today. Yep, it seems like it's stocks that need to borrow money. So it's negative for home builders, high yielding stocks, stocks that need to borrow money, speculative, non-profitable companies. So there's biotech is definitely speculative and they need to borrow money. That's why they're down. Home construction, of course, follows interest rates. Telecom is a high yielding sector. That's why they're down. Because if you get if the interest rates are going up, then there's less demand for high yielding. Um, Healthcare is a high dividend related stock sector. So that's why it's in that same category. Let's look at the ones that are holding up the best. Discretionary, utilities, semiconductor. So that's positive for large cap tech stocks, financial, insurance, and insurers. Okay, brokerage firms. All right. So that kind of the ups and downs of the stock market matches the 10-year almost perfectly today. Right. That was a good exercise. Let's look at the market movers, stocks going up and down the most. We have Warner Brothers Discovery. Um, these are kind of th these media stocks are they were kind of thrown out because they're not very profitable, but because there was cord cutting. So if you have cord cutting, you have less profit from cable companies, running the Warner Brothers Discovery channels. Now they're actually in the process of merging into maybe one or two big companies. So um, what happened was Paramount had a merger with Warner Brothers. So the synergies might help the two companies compete against Netflix and Disney. So, but I don't know anything about that kind of stock. The media companies, it's like a totally different animal. Um, Tesla is up a lot today. I'm not sure why. Why is it? I'm not sure. We'll look at this. Let's look at the chart of Tesla because we do follow this one. You can see that Tesla is in an uptrend, well-defined uptrend, and we have where it's basically overbought right now at the top of the range. So it's extremely dangerous to buy Tesla right now, unless it breaks out of here. I don't know if it'll break out. Um, we do have kind of a sideways range for about a year right now. Yeah, about a year. So it's been kind of sideways. Um, Seems like it'll continue in this channel here. So we're at the top end of this range. The fundamentals for Tesla are abysmal. They have their earnings are going down. I like to buy stocks that are at least going up 10% in their earnings every year. And it's really hard for me to put money into a stock um, that doesn't have a whole lot of numbers behind why it's going up or down. It's like a cult stock. Right now, there's a lot of people saying that it's valued based on its robo-taxis and maybe robots that are going to be built 5, 10 years from now. Um, and Elon Musk thinks the robots that he's making like Optimus robots are going to be the best product of all time. And we don't know. There's a lot of optimistic um, things that Elon Musk says. We don't know if it'll happen or not. But if it does, this stock is worth a lot more than it is now. But it's we've been going over this for a while. It's like 5 times overvalued based on current earnings. Okay, so let's look at other stocks going up and down. Micron. Okay, we had a good earnings report and guidance from Oracle on Wednesday, and a lot of the stocks that were involved with Oracle in building out data centers are going up on the news. So we have Micron up like like a lot this week. They make I think the memory for some of the advanced AI architecture. We have Palantir. They're up 4% in AI play. So a lot of these are AI related. Supermicro, these are all build out. Okay, so that makes sense. This today is a AI infrastructure build out themed day. One's going down the most. We have some profit taking on Oracle. Oracle went up 30% Wednesday, and it's giving a little bit of that back now. We have a lot of health companies going down. I think the current administration is going after some of the drug companies' vaccines, and any company that's selling vaccines for COVID are taking a hit because of that. So we can't predict that. That kind of goes with our idea at the beginning of this talk when we were talking about the healthcare stocks, why they're out of favor, because the current administration is kind of making rules up as we go that are bad for the drug companies. So that's keeping the valuations very low for this sector. It's hard to invest in that right now. Okay, so now that was a good exercise. Let's go back to our meeting notes. Let's look at Dan Now's picks from the beginning of the year. ADTN, this is an AI networking play. It's up 21%. That's the best performing stock of his picks this year. We have KBWB, the the big bank ETF is up 19.5%, which is pretty amazing. Cisco is up 12%. And IJJ, this is the mid cap ETF, is only up 5%. That's the worst pick of the year. All right. So let's look at some of these charts that I pulled out that are interesting. You can see that Apple is in an uptrend. You see this well-defined downtrend. It basically broke out of that right here. You can see that this 20-day exponential moving average, the yellow one here, Apple is hugging that line right now. So it seems like we are in an uptrend, and we had some good news when they released a iPhone 17 this week, and people are raising their estimates. So it looks like the stock is back in favor. We got a defined range right here of this is the top and this is the bottom. If you're interested in the stock, the best time to buy it is when it's nearer to the bottom of the channel. And it's getting to a point where it's oversold right now. It's almost oversold, maybe another day or two. Let's look at another one. Let's look at Pepsi. You can see that Pepsi has been a huge downtrend. We had some good news that came out right about here. There's an activist investor that's taken a share of a large position in this company. A lot of times when you have activist investors, they agitate the board and they make changes and make the stock more profitable. So this is a stock that I haven't I've had since like 2010 or so, and it yields like 3 or 4%, and it's like a dividend part of my portfolio. But you can see that it's going back above all of its moving averages, and this is kind of making a turning point. And it's oversold right now. You can see that it's oversold at the bottom end of its range. So that's usually time I like to buy a little bit. All right, let's look at Visa. Visa is also in a position where it is in an uptrend. You can see that um, we have kind of a sideways pattern going here, but it is in an uptrend and it's at the bottom end of its channel and it's oversold. I've owned Visa since it IPO'd back in 2008 or something, and it's a reliable 13% or so compounder over time. I don't see any major disruptions in their business model. Both Visa and MasterCard, have an advantage where banks offer 1% back, on every charge. Whenever you charge with a credit card, then banks give you 30 days to pay it. So it's like a 30-day free loan. And a lot of the competing ways to pay don't offer that. So if you want to pay with Bitcoin, you pay with cash. You don't get a 30-day um, loan to pay your bill. So it's gonna be hard to disrupt the Visa and Mastercard duopoly. We'll see what happens there. Okay, this is waste management. You can see that there's a sideways pattern going back almost a year. Um, and they say this is like a basing form. So basically it's oversold right now. It's at the bottom end of its trading range. Um, it's a duopoly with Republic Services, and um, they are overvalued, but they've been overvalued for 15 years. They trade for a peg ratio like 2 or 3, but for me, it's a buy and hold, and it pays a dividend. So it's more of a dividend stock for me that grows 5 or 10% a year. And but it is oversold right now. Let's look at T-Mobile. T-Mobile is a stock that's taking market share from Verizon and AT&T, and they're also establishing a internet kind of business. So they're taking more business away from Comcast and Spectrum and a lot of other networking companies like AT&T. So they're oversold right now, you can see, and they're at the bottom end of their trading range. Um, so we're going to go over the fundamentals of T-Mobile a little bit later. Okay, so let's look at the screen that I have here for this week. I picked out two stocks, um, T-Mobile, because we haven't gone over that in a while, and Adobe. Okay, so Adobe, we'll go over that one first. Okay, this is like the worst chart in the stock market. Look how bad this is. It is like a well-defined downtrend. It's really hard to invest in a stock like this because you don't know where the bottom is. And and this stock used to be like a 13% over time grower. They didn't have a whole lot of competition, but now they have AI, they have Figma, they have more competition than they used to have, and there are less people employed. So you have less licenses for the people for the less people. So you have a couple things going wrong with this company. They do have, of course, the um, PDF format. That's on everyone's Windows computers. So they get to push whatever products they want. And you can see how easy it is to accidentally press the Ask AI assistant, which I don't want, but they're forcing me to use it. Um, so they might get some money out of that. Let's look at their growth projections. Okay, they're expected to grow 13% from this year to next year, then 14% the year after. Right now, their PE ratio is 15. So they're growing at 13%. So their PEG ratio is 1.1. So that's like maybe 10% overvalued. Um, but the company, they could be in the process of being disrupted by AI and Chat GPT. So if you can have a Chat GPT draw a picture of something for you, why would you need, why would the average user need that um, Photoshop? So the other thing, okay, so let's look at some more numbers. Their 4P is 15. Their PEG ratio, according to Yahoo Finance, is 1. So Yahoo Finance thinks it's totally fairly valued. So we've kind of reached, usually when a big stock that's a blue chip goes down, it goes down to a PEG ratio of 1 usually before it kind of bottoms um, because that's the way the stock market works sometimes. But if there is a fatal flaw that I don't know about, where maybe in 5 years everyone's going to be using AI and no one's going to use Adobe products anymore, I don't know. But they're introducing AI into their offerings. So let's look at let's look at their profit margin is 30. That's 3 times what we're looking for. Return on equity is 52, 5 times what we're looking for. And their total cash, they basically have no debt if you X out the cash. So here's what um, here's what the Google AI says. Adobe stock has declined significantly due to increased competition with AI-powered tools. Fears about the disruption in its traditional software business model, concerns over its ability to translate its own AI investments into substantial growth. Questions about its ability to grow revenue as effectively as it has historically. So while the company has dominant market position and strong profits, recent performance in a challenging competitive landscape in the age of AI led to investor caution and lower valuation compared to its past. Okay, so this could be a company that is in the process of being disrupted. So the reasons, according to Google AI, for the stock's decline: AI disruption, slowed revenue growth, intensifying competition, skepticism about AI strategy, uncertainty in AI adoption. Um, okay, let's look at what CFRA says. They have a buy on it and a target of 425. They think that the fair value, it's undervalued by 40%, which is pretty amazing. Let's look at, I always like to look at this investment rationale. Our buy reflects, our buy they have a buy rating on it, reflects Adobe's ability to sustain a 7 to 9% growth, AI monetization potential, and valuation. Despite well-known concerns about AI eating software, we think AI will prove to be an extension to software applications. We positively view ARR, annual recurring revenue acceleration, plus 13%, with AI influenced ARR surpassing 5 billion. Okay, so enterprise constant, enterprise content automation, Gen Studio versus integrating entire content supply chain. Um, okay, so CFRA thinks they're 40% undervalued. So this is worth, diving into, because usually this is pretty accurate. It's fair value. Um, it's a little scary though with AI kind of maybe taking their business away from them. Look at this um, earnings over time. You can see it's going up around 10% recently every year. So according to them, it's a 9 or 10% growing company. The revenue is likewise going up around 10% a year, 13% a year. So this is kind of right in the wheelhouse of what I want in a long-term stock. I want something that's kind of growing their earnings at least 13%, a year forever. And Google is one of those stocks, that keeps growing 14%. They find a way. Um, the one problem about this company is you don't know if they're being disrupted or not. Let's look at Morningstar. They think also it's 40% undervalued, 37% undervalued. So their fair value estimate is 560. Um, so let's see what they said about it. Adobe earnings, the sky is not falling as AI and new products gain momentum. So Adobe is actually developing AI and incorporating into their products. And they had according to them, it's a decent earnings report. They're growing by 10% a year, year over year. And the margins are 46% in that top guidance. So the guidance, um, so their margins are getting better. So that means they're investing less and they're profitable. This is a tough one. I guess that this is my confidence level in this stock is like 40%. I know it's a blue chip. I know it's going to be hard to replace a product line like the Adobe Cloud. They have Photoshop and a lot of modern day video and web building applications. But there is, I would say maybe 30% confidence in this stock due to all their competition. So I wouldn't put a whole lot of money into this stock. I would put like maybe 0.3%. That's less than 1% maybe into it. And if it goes down more, because it isn't a downtrend, if we look at the stock, we don't know where the end is. It could continue to go down. Um, so I'll put 0.25% in this stock. And if it goes down more, then I'll put another 0.25% in. Um, I guess time will tell. Um, okay, so let's look at another stock. T-Mobile. Let's look at T-Mobile. This is one of my favorite stocks in my portfolio. Um, let's look at its earnings estimates. They're scheduled to grow 20% from this year to next year, and then 18% from the year after, from 26 to 27. So let's say they're growing at 20%. Their PE ratio is 22. That means their PEG ratio is 1.1, and that matches exactly what Yahoo Finance says. So, and their forward PE, yeah. So the profit margin is excellent, and the return on equity is a little bit more than what we're looking for. The total cash, oh, this is a problem here. They have 118 billion in debt minus their cash of 10 billion. That's like 108 billion out of, so half of their market cap is debt. So they got to work off this debt. That's like one of the biggest problems of T-Mobile. But they do make, um, they are cash flow positive. So they're going to pay that off eventually. They bought Sprint, which gave them a lot of spectrum and made them probably the best wireless area coverage in America. So they're eventually going to pay us off. That's going to be a story we watch over time. But as interest rates go up, this debt is going to have to be refinanced, and it's going to be cost more as interest rates are higher. All right, so let's look at T-Mobile's chart. You can see that I think we looked at this before. It's at the bottom end of its range. It's oversold right now. Um, it doesn't trade like the other telecom stocks because this is kind of a growth stock. They don't pay a dividend, much of a dividend. And AT&T and Verizon, they might grow 0 to 2% and pay its 6% dividend, whereas T-Mobile grows at 20% and pays a less than 1% dividend. So it's a totally different um, chart than the other stocks. Let's look at what CFRA says about T-Mobile. They say it's a strong buy. And they say our strong buy reflects our expectation that T-Mobile will continue to outgrow peers. We expect the competitive pressures to remain fierce, but positively view free cash flow growth potential and churn. Their 5G network is ahead of both Verizon and AT&T, which combined with its aggressive pricing plan has enabled it to capture market share while competitors struggle to keep up. That is our thesis right there. And they have synergy with the Sprint merger. So, um, okay. So let's look at the fair value. They say that it's overvalued by 7%. So it's very close to fair value, they're saying. And you can see that the earnings have, well, they're kind of inconsistent here. Look at that inconsistent, but recently they're going up like 20, 30% per per year. Let's look at the revenue. Revenue, I'd say it's going up in like 10% a year. So that matches what we're looking for. And you can see they're getting more efficient over time. There's a 5, 4, 3, 12, and 17. So that means they're getting a little more efficient over time. So T-Mobile, let's look at what Morningstar says. They said their price to fair value is 1. So they think it's totally fair priced right now. They say they're taking share without excessive discounting. So they increased their fair value just a little bit. So we all know that T-Mobile runs the best, most frequent ads, and they have very aggressive discount ways to get people to sign up for their service, maybe $25 a month if a lot of people sign up, and they give a free phone too. So, and they pay off your phone. So a lot of good approaches to getting people to sign up with their network. Um, let's look at Okay, let's look at the story that came up Wednesday. Oracle reported their earnings, and analysts were slack-jawed. Okay, Oracle's stock was soaring following the company's earnings report Tuesday. It went up 30% in one day. Analysts were gushing about the numbers and the company's prospect with AI. I'm sort of blown away, says the analyst from Guggenheim. Oracle now sees cloud infrastructure revenue climbing to 144 billion over the next 4 years. Okay, so I waited a couple days after that report and I looked at the earnings estimates. Seems like they're growing at 21%. They're 13% from this year to the next year and then 21%. So let's use the 21% because it seems like 13, 21, then 34% after that. So if they're growing at 21%, that's next year's growth. The PEG ratio is 2.0, so that's 2 times overvalued. So this is a very expensive stock right now. The forward PE is 42, which is very high for a tech stock. Most of the big tech stocks right now are trading between 25 and 30 PE. And that's like double the PE. So Yahoo Finance agrees that it's twice overvalued. Their profit margins are that's double what we're looking for, and the return on equity is amazing, 6 times what we're looking for. So it's a quality stock. It's just kind of priced for perfection right now. And let's look at the um, look at the chart. You can see we're in an uptrend here, and we basically went out of the range just for a day, and then we're back right now at the top end of the range. So, and we're overbought. So it's not a good time to start buying the stock. It's definitely overvalued. It's hyped from that earnings report. And we're approaching one of the worst times of the year in the stock market for monthly wise. So this is one I would tend to buy down here if I was looking into it. But still, it is overvalued by 2 times right now. It's hard to buy a stock like this that's 2 times overvalued when there are other high quality companies trading for less of a multiple. Okay, let's look at what CFRA says about Oracle. They said they have an upside tied to Oracle's infrastructures as a service, IaaS, business opportunities, and tied to software as a service offerings as new agentic use case emerge. In our view, we are positive on healthy cloud services growth. It seems like they sell a lot to OpenAI, um, which OpenAI uses for agentic kind of AI queries. So let's look at what they say their fair value is. They say they're overvalued by 31%. So they agree, CFRA agrees with us that it's overvalued. They only think it's overvalued by 30%. I thought it was overvalued by 100%. Um, okay. So the earnings, you can see this is an example. It's not very consistent in their earnings. You can see that they're all over the place. They have $2, then 85 cents, then $3, $3, $4, back to $2.22, which I don't know. It's not like a consistent compounder. Um, so this is kind of flaky for my taste. It's, we have CFRA saying they're overvalued, and um, let's see what Morningstar says. They said they're undervalued by 27%. Okay, so remaining Oracle's remaining performance obligations for the first quarter increased 359%, primarily due to expanding relationships with large language model providers. Management also expects Oracle Cloud infrastructure to grow 77% in 2026 to reach a annual growth of 70%. So if the earnings estimates right now for Oracle are still 20%, um, portions of their company are growing at 70%. And if that overtakes, the traditional what they're selling, we'll have to keep our eye on that. Then they're undervalued. If the PE ratio is 42 and they're growing at 70%, but that's only for a small portion of what they're doing right now. So this is one we'll watch, but right now it's super double expensive. Um, okay, this is the last thing I wanted to say. Um, there's a little news story that says Goldman Sachs David Kostin on year-end playbook. Okay, so he has these ideas because there's a lot of managers that are behind the S&P 500, and they're looking for ways to catch up so they don't look so bad at the end of the year. So his what he was saying is that you have alternative asset managers whose valuations have yet to recover back to post-election highs. The second thing is companies with high floating rate debt as earnings estimates benefit from Fed cuts. So his theme is stocks that are highly indebted will get a benefit whenever the Fed cuts the rates. And then gold mining stocks, um, he advises you to buy because he expects prices of gold to rise 14% through the middle of next year. And he says that's because of strong central bank and ETF demand. So we also have the dollar going down, and it continues to go down. So if the dollar goes down, then the values of um, materials that are priced in dollars go up. That's another reason why. So, so his summary here, only 30%, 38% of mutual managers have outperformed year to date. So he thinks if banks and the financial stocks will benefit from the lower interest rates, opening of the IPO market, and 401k reforms. So Dan Niles was on this at the beginning of the year. He was buying banks January 1st. But we know now that more than we know then. We know that they're going to reduce the rates towards the end of the year, almost 75 basis points. Now we have gold miners, he says, GDX. Gold, he said gold is going up 17% from here to middle of next year. So that's the second thing to buy. And the third thing is companies that benefit from the rate cut, which are companies that are indebted. And he thinks between now and the end of the year, the stock market should move up or 2 to 4%. So that is everything I had to say. One more last thing. This is Friday's stock market heat map for the S&P. The bigger blocks are the companies that are larger companies. You can see that we had a lot of the big tech companies go up a lot today. We have Microsoft. Um, One of the reasons why Microsoft has gone up a lot this year, um, they own half of OpenAI. OpenAI is in the process of going public, and there's a lot of companies that recently are going public and exponentially going up. And Microsoft has half of that company, which might be worth like a 500 billion in a year. Um, and Microsoft also benefits from the AI infrastructure. And whenever Oracle went up on Wednesday, a lot of companies like Microsoft go up also because they sell similar items. Apple had their developer conference where they released the iPhone 17. So there's a lot of excitement about that. So looks like Apple is in an uptrend right now. And what other companies? Tesla went up 7% today. I don't know why, but um, we can see on that chart it's at the top of end of its range. It's pretty dangerous right now. Their stock price doesn't match their earnings. It's really hard for me to even look at this one because it's so overvalued. All right. That's all I had to say for today. Hope you enjoyed the talk, and I'll see you next time.